ton of banking crises in my life. The outcome is always the same 100% of the time. Emergency rate cuts as fast as you can. Now, we're not there yet, but once we get the next leg lower in these banks, they didn't close well today, and the bond yields, 10 years closed on its lows. Once we see the next leg of that, which is why I've got the Buy Bonds, Wear Diamonds t-shirt, because the only thing you do in a situation like this is buy bonds. Once it makes the next leg lower, that's going to set the alarms off. We've got to get through the Fed meeting. I also, which is very controversial, I'm very bullish equities because more cowbell. If you debase the currency, equities go up. So I'm very bullish crypto, very bullish bonds, very bullish technology stocks in particular.
As the banking crisis continues to play out, doomsday predictions are coming in thick and fast. Amid all the negativity, economist Raoul has a positive take on the developments. A 2008 redux, he says, can't happen despite many on FinTwit calling for it. In 2008, asset prices fell so hard that it resulted in a collateral spiral. Following quantitative easing, it took 6 months for collateral prices to stabilize for debts to become manageable, the economist noted. With QE, the currency is debased and inflationary pressure rises before collateral is called at a systemic level, he added. Debasement is lowering the value of the currency. Powell noted that this is what is happening currently, with the Fed's balance sheet rising quickly in a financial crisis, the collateral prices begin to rise. Equities, bonds, crypto, and gold are rising commensurately, he said. QE, according to the economist, is debasement and does not drive liquidity into assets, but it is an adjustment in prices to account for the weaker purchasing power versus scarce assets. Powell noted that with QE, wages and earnings don't rise, but price to earnings rise, and people can afford less per dollar of investment in all assets from housing to equity to gold to crypto. Powell argues that the crisis that we are experiencing is more similar to the 1990 recession crisis and not the 2008 financial crisis because the yield curve is inverted and interest rates are high. We are now going to listen to Raoul as he addresses the relationship between the crisis we are having and that of the 1990s and why it is not similar to the 2008 crisis. He also talks about quantitative easing and how it is the magic pill for this crisis. As you watch, make sure to like it, subscribe, and drop your comments below.
They have to steepen the yield curve as fast as possible, so I think they cut rates 200 or 300 basis points in pretty short order. So I'm talking into late summer, September or so. We will go into recession. Andreas and I have been flagging this forever. It was, in our forward-looking indicators for a long time. We go into recession. My guess is we come out the other side, i.e. we hit bottom maybe this quarter or next quarter. And then we come up the other side. The other side's going to be slow. Trend rate of GDP is slow, and it's going to be ugly and messy. But right here and right now, this banking crisis is not going to go away. And certainly by lending a bunch of big banks money and putting it onto other people's balance sheets, none of this shit's going to work. It just smells. The whole thing smells. And it's going to have to unravel in the age-old way, which is everyone's going to start panicking about the insolvencies in these firms, whether it's deposit flights or their books. And in the end, the Fed has to come with a cowbell.
Some of these banks lending money at the Fed now go bankrupt, then this will turn into QE automatically. And that is probably the end game here anyway. So whether we call it QE or not, it doesn't really matter a whole lot. If you look at the move in the 2-year bond yield just this week, then try and compare it to the move in the 2-year bond yield after Lehman or after 9/11. The moves that we saw after 9/11 and the Lehman, they look like a drop in the ocean compared to what we've seen over the past week here. So the bond market is screaming, and you should never bet against the bond market screaming this loud. I need to emphasize that. So I agree on the direction of travel with Raoul here.
If your collateral is going down, you go bust. But what QE does is make your collateral go up optically in price. And so it stops the bankruptcies. Doesn't mean you repair the P&Ls or anything else, but if your collateral doesn't fall, you're okay. So I don't think it can ever get as bad as 2008 using this particular mechanism. There's an outside chance for sure. I don't think so. I don't know. Andreas, what do you think?
The Fed did last Sunday was essentially to backstop the US Treasury market with this new lending program. They've been telling banks since 2008 that the US Treasury market is the safest in the world, and therefore they need to back it up. They've been telling banks to hold treasuries in their high-quality liquid asset portfolios. It's simply regulation. They need to hold these assets, and therefore the Fed needed to step in to ensure that the treasury market functioned. So in that sense, it kind of resembles what happened in the UK during the autumn last year, that the central bank simply had to step in to backstop the core functioning of the yield curve and the core functioning of the treasury market locally. And therefore, I perfectly agree with you, Raoul, that since the Fed has now backstopped the US Treasury market, it will not turn into a collateral crisis. What it will turn into is a major move of deposits from small and medium-sized banks to a very few large banks. So we will end up with a US banking system that will look a lot like the European banking system after this crisis is over. And I can guarantee you, by watching the price action in European banks and after having worked for one of the biggest Northern European banks, that it is not a bullish scenario for US large caps.
The Fed needs to print and collateral prices will rise. If the collateral is worth more, then the debt is not called at a system-wide level, unlike in 2008, Powell said. QE is not inflationary, whereas fiscal policy is, and it is short-lived, the economist said, pointing to Japan, which has been through this many times. The trend rate inflation is driven by demographics along with debt load, the economist said. It's not money going into equities from too much liquidity seeping into the system, allowing people to buy, but it is debasement that does this, he added. Let us listen to what Powell has to say about quantitative easing and economic growth.
So economic growth, we're going into recession. I think it's more like 1990 recession, which was pretty nasty. It didn't, the stock market fell 20% that time. Bond yields collapsed. The banking system was creaking at the seams. Commercial real estate took 4 years to recover. Jobs took a long time to recover. I think that's what we're doing. But I think it's, again, a lot of people are looking at 2008 or 2000 saying it's going to be something like this. I don't think it is. I think it's a traditional recession with credit contraction that creates an overhang in some parts of the economy. So I think we go down fast, take a long time to recover, because commercial real estate is stuck on all of these small banks' books. And I was sitting down with the commercial real estate portfolio manager for one of the biggest pension funds in the United States 3 days ago. And he's like, some of this stuff is never going to get used and never going to be sold. They're going to literally have to bulldozer it down. He said it's already seeing it in many cities in the US, is that people just aren't going back to work. Look at Real Vision. Maggie, when's the last time you went to the office in New York? We're stuck in a lease. We reduced it from 65 people to a 35-person lease, and still 2 or 3 people go to the office. Even here in Cayman, it's only a 5-minute journey for us. There's 2 people in the office. No, it's finished. They're stuck. And those losses are going to have to get eaten by the pension system because they own it. I mean, I've been calling for the oil to get to $60, and I think I might be optimistic. Let's see. Now, we all understand the supply shortages, but demand wins every time. Everyone forgets this. The great conversation with, as ever, Dwight Anderson, who's like the world's best commodity hedge fund manager. And he's like, yeah, I'm bullish on oil on a structural supply story, but you got to factor in demand. And in a recession, nobody uses oil. We've got stuff like excess inventories everywhere. So that means industrial production slows down. And if there's excess inventories, then industrial production in Asia slows down as well. So there's going to be less demand for oil. I mean, all of the commodity prices now en masse are down year on year. They're negative. So that's deflation. There is, I do not see a single shred of evidence to suggest that inflation is sticky. I think it's a false narrative, and it's going to get taken out and shot over this next few months.
Markets have once again changed their mind about what they think the Federal Reserve will do next week regarding interest rates as cracks begin to appear in the financial system. The U.S. Central Bank's original plan to potentially raise rates by another 50 basis points after its March 21 and 22 meeting has been thrown into question in the past week due to growing signs of turmoil in the global banking sector. After odds for a half-point rate hike spiked to almost 80% following Fed Chief Jerome Powell's hawkish congressional testimony on Wednesday, March 8, those bets evaporated in just a few days. with chances of a 50 basis points move plunging to under 2% by the morning of Monday, March 13. Fed Chair Powell had been widely signaling a 50 basis points hike in the lead-up to the March FOMC meeting, but worsening fears about the health of the financial sector in the past week paved the way for a more restrained view of monetary policy. As the U.S. central bank raises rates, things in the financial system start to break, often resulting in a crisis. We had the Latin American debt crisis of the 1980s, the long-term capital management hedge fund crisis in 1998, the tech bubble bursting in 2000, and the U.S. subprime housing crisis of 2007. In this case, U.S. regional banks have been under intense pressure since last week, following the swift closures of Silicon Valley Bank and Signature Bank, the second and third largest failures in U.S. history. Then came news that Credit Suisse may need a bailout after a major Saudi investor said it would not provide more capital to the troubled Swiss lender due to regulatory issues. That forced the Swiss National Bank to step in on Thursday morning with a $54 billion lifeline to help shore up liquidity conditions. Raoul Pal believes that Powell and the company will decide to raise rates by 25 basis points at the upcoming meeting and signal that further hikes are on hold for the time being. That would effectively end the Fed's year-long monetary tightening cycle, considering the troubling circumstances in the global financial system. What do you think of Raoul Pal's view on this? How high do you think the rates would be raised? Let us know your thoughts in the comment section below. Make sure to give us a like, subscribe, and turn on notifications for future videos. Thanks for watching.